Joining us now with more on the markets, Noah Blackstein, Dynamic Funds Senior Portfolio Manager. Noah, we looked into the abyss when I think the S&P got down to, God, was it 4,800? I don't know where it was. We're almost all the way back to new highs. More new highs, or now we look around and say, okay, what do we do? We're back to where we started the year, basically. Up a little.
We're up just a little. So, I mean, from the abyss, we're up a lot, obviously. But, just for this year, we really haven't done very much, only up about 3.5% or so. So I think we can go higher from here. I think economic growth is okay. It's a little bit slower than it was. Rates are obviously too high. Having said all that, it feels like, from what we're hearing anyway, that businesses are on track. Some business that didn't close in the first quarter is beginning to close now, and it feels to us like the economy is doing okay. I think we're looking at heavy investments in AI, we're looking that's going to continue, but we're also seeing a little bit weakening of the labor market in here. So, I think there's a lot predicated on some of the decisions that get made. We're of the belief, obviously, that the Federal Reserve's rate level is too high right now, especially given where the labor market is. But as we get these two cuts, this year, at least two cuts this year, I think, as the residential investment is going to be critical for overall GDP growth, because really, if you're looking at CapEx spending in the U.S. today, it's really almost all driven by what's going on in AI and in technology. And residential investment has been tough. You're going to have down housing prices this year if rates continue this way. So we think the economy is on a good path, and we think the Fed should be a little bit more accommodative than it currently is. But the markets can definitely work higher as the economy continues to gain confidence. As I think continued deregulation happens now that we've sailed past the most difficult parts of tariffs.
Yep. Do you expect to see trouble ahead in the numbers based on the tariffs? I'm talking about the inflation side of things. And you said, yeah, the economy's doing well, so I think we could have some cuts. That doesn't make sense. You mean we could have some good cuts because there's no inflation?
Correct. There really is, and I think real rates, by holding real rates and having inflation continue to decline, de facto they're continuing to raise real rates, and they're continuing to run off the balance sheet. So, you're in this period where they're continuing to de facto tighten, which really doesn't make any sense. I think the inflation numbers are good. Look, there isn't a central bank, these tariffs are a tax, right? So in 2018, the Trump administration's tax cuts came through, and the Federal Reserve was going to go well above neutral because tax cuts were inflationary. And now the tariffs, which are taxes on foreign goods, are coming in, and these taxes are inflationary. So tax cuts are inflationary, and tax hikes are inflationary. None of it makes sense. This idea of waiting for this pass-through doesn't make sense either. You're either data dependent or you're not. Right now, where rates are would suggest you should cut. If there's massive pass-through and lingering inflation that goes on 6 months or a year from now, you can raise at a later date. Right now, this wait-and-see approach, given the labor markets, you've seen unemployment tick up 4 months in a row. It doesn't seem to make much sense. I'm not really. Their arguments are fairly weak here. I think arguments made by people like Waller more recently have been much more aligned with where I'm at. In terms of, you could probably cut sooner given the progress made on inflation and the lack of pass-through thus far.
So how bullish are you? I mean, we got to remember the gains we had in the last 2 or 3 years. You think we can get gains like that when it's all said and done?
Gains in the last 2 or 3 years, but the losses in 22, as we went from basically 0 to 525 basis points of Fed hikes in a very short period of time. And so we've had gains in the last few. So I think it's going to have to be earnings driven. We're looking next year for something like $300 of earnings power for the S&P 500, maybe $400 of cash flow. So 20 times earnings, 14, 15 times cash flow, not crazy expensive, but not certainly cheap. And so the leg that has to go on here are companies being able to meet or exceed those expectations and deliver on growth. So, I think if you look at the market overall. You'll find pockets of opportunities. And I think a broadening of the market is beginning. It was derailed in the first quarter, but it's beginning. And so, for us, I think that there's plenty of opportunity out there in the overall market. In general, the market's fairly valued, but there are certainly pockets of opportunity. Even in some of the bigger names, NVIDIA more recently has been going sideways went sideways for about almost a year there, and now it's beginning to move again. And that stock actually got relative to its growth to a reasonable multiple. We also think the financials can continue here, both based on deregulation and then what we think is going to be a really interesting opportunity with the Genius Act and other legislation on stable coins and sort of new payment networks. Plus, I think a lot of the banks and a lot of the financials will be able to employ AI for a lot of the processes they have today and see tremendous cost savings. So there are certainly areas where we think there'll be margin improvement and earnings improvement over the next few years. And that's what we're trying to focus in on. It's a much more benign macro environment.